Most Aussies here, you've got equity and think it's free money. But banks, they are happy to refinance you. Brokers, they're keen. And before you know it, you've doubled your loan, extended your loan term, and locked yourself into repayments that keep you stuck for decades. So in this video, I'm going to show you the hidden risks of releasing equity, the stuff not explained properly, and how to do it the right way. So it actually speeds up your property journey instead of quietly sabotaging it. And stay with me, because later in the video, I'm going to share a true to life example of how two investors both released 160 grand of equity from the same starting position. One used it well and bought another property. The other, they used it badly for lifestyle and debt consolidation. Now, 10 years later, the gap between it is more than $500,000. Let's start by clearing something up. Equity release or cash out refinancing isn't evil. It's just a tool. Used well, it can fund a deposit for your next investment property, pay for renovation that generally increase value or rent, consolidate high interest junk debt into lower home loan rate type debts. If you fix the behavior that created that debt in the first place. Now, used badly, it can blow out your home loan, sharply increase your monthly repayments or total lifetime interest. It can also strip out the very equity buffer that protects you when rates rise or property values dip. So, in this mini masterclass, you're going to learn 1, how equity release actually works in Australia with real numbers. 2, the biggest risks and pitfalls people fall into. Number 3, how to assess whether releasing equity makes sense for you right now. And finally, a practical checklist for you to do it safely and strategically. By the end, you'll know when to say yes to releasing the equity and when to absolutely walk away. First, quick basics in plain English. So what's equity? Equity is the current market of your property minus what you still owe on the loan. So for example, if your home in a Melbourne suburb is worth around 800K today and your loan balance is 360, your total equity is 440,000. But here's the important bit. Lenders will not let you borrow all of that. Most banks will let you go to about 8% of the property value without having to use lender's mortgage insurance, especially if you're using it for investment or for renovation purposes. So let's run a real example here, similar to what lenders show. So think of this, property value 600K, current loan 320, 80% of that value is 480. So the maximum you can refinance to is $480,000. The maximum cash out or equity release is at 480 less 320, which is 160. So in that example, you could access up to 160 in usable equity if your income or borrowing capacity supported it. That's typically done through a cash out refinance. So your old loan is paid out, a new larger loan is put in place, say 480, you receive the difference, which is at 160, into an offset account or as redraw, which you then use for your investment or other purposes. Sounds pretty simple, right? But notice what happened. Your loan went from 320 to 480 in one single hit. That's where the risks kick in. So what are the risks? Risk number 1, treating equity like free cash. One of the biggest things is actually psychological. The equity feels like money the market gave you. You didn't have to work for it. You didn't do overtime. You didn't have to do a side hustle. The suburb just went up and suddenly your bank app shows a bigger number. So when a lender says you could release 160, it can feel like free money, but it's not. That $160,000 is new debt. It's secured against your home or investment property. You're paying interest on it. It increases your total monthly burden. It increases your repayments and it reduces the buffer between your debt and the property value. If you use it to buy an investment property with a clear strategy, different story. But if you use it to say, buy cars, toys, go on holidays, wipe out credit card debt and rack the card up again, find a lifestyle goal beyond your income, you just turn good equity into bad debt. ASIC and consumer groups have been warning people for years. We're often encouraged to draw down more than you actually need when they use equity release products that in the long term, the costs can be massive. So rule number 1, equity is not a lotto win. It's leverage. You need to respect it. Risk number 2, extending your loan term and total interest. So this risk is a little subtle that the banks are very happy for you to not notice. When you refinance to release equity, you're often resetting the clock on your loan term back to either 25 or 30 years. So let's say, for example, you originally borrowed $400,000 over 30 years. You've been paying it down for 8 years, so there's only 22 years left, and your balance is now 320. If you do nothing, in 22 years, you'll be mortgage free. Now, if you refinance 80% or a higher value, your new loan is now 480,000. Your new term is another 30 years, unless you specifically pass otherwise. So what does that do? On the surface, it may seem like it even lowers your minimum repayment because you spread the debt over a longer period, especially if you score a slightly lower rate. Sounds good, right? But over the life of that loan, you can easily end up paying hundreds of thousands of dollars more in interest compared to if you just kept hammering away debt on the original mortgage for the remaining 22 years. Banks and regulators like APRA expect lenders to stress test your ability to repay at higher rates and longer terms. But remember, they're not responsible for your long-term wealth. You are. So whenever you look at equity release, you need to ask, what does this do to our loan term? What does this do to my total interest paid? Am I okay with that trade-off? And do I have a plan to pay it down faster? Risk number 3, killing your safety barrier. This is about resilience. Your equity is your shock absorber. Think of it this way. If interest rates rise, your property value dips 5 to 10% in a downturn, or you need to sell unexpectedly. That buffer between your loan and the property value is what stops you from being in negative equity or having to walk away with nothing after selling. APRA's been very clear about this for years. Lenders should be careful with high and loan to value exposures and ensure borrowers can withstand shocks or downturns. When you release equity up to the hills, especially if you push above 80% LVR and start paying the L1, you're effectively eating into your safety margin. Think about it this way. At 60% LVR, you sleep well. 80% LVR, you're still okay, but less cushioned. At 90 to 95% LVR, in a downturn, you can be underwater very quickly. The pitfall is releasing equity because the bank says yes. With that asking, 1, how much buffer do I want to keep? 2, what happens if values fall 10%? And 3, what's your exit strategy if something does go wrong? Risk 4. This is a big one for investors. Not all uses of equity are equal. There's a huge difference between using equity as a deposit on a growth-focused investment property in a strong summer and using equity to renovate your kitchen for $80,000 in a way that adds maybe $30,000 value, or using equity to wipe out $50,000 of credit card debt, then running the cards back up again. ASIC consistently warned that using home equity to fund lifestyle rather than long-term productive investments can leave you with less equity in retirement and fewer options later on. So in other words, what we're saying is, if the equity release is tied to a clear strategy with projected yield, growth, and exit options, that can be sensible risk. If the equity release is just solving today's pain by borrowing from future you, that's a clear red flag. So before you sign anything, ask, will this use of equity increase my net worth in 5 to 10 years? Or am I just reshuffling the debt and kicking the can down the road? Next risk. Not all equity release is just a straightforward refinance. Now, especially for older Australians, you're seeing reverse mortgages, home reversion schemes, government-backed equity access schemes. Now, Money Smart have found that a lot of consumers struggle to understand how these products compound over time. Interest on reverse mortgages can grow very quickly, eroding your equity. In some schemes, you're literally selling off chunks of your future home value, reducing what's left for your retirement or for your legacy. They've also flagged that advice around equity releasing is often inadequate, with people being encouraged to borrow more than they need or not fully understanding the long-term costs. So if you're older and you're looking at these reverse mortgages or home equity schemes, or if you're younger or as an investor being pitched fancy equity products, 2 rules apply. Don't sign anything you don't fully understand. And secondly, get truly independent financial or legal advice, not just advice for the person selling you the product. All right, let's come back to that example from the start. So same starting position, 2 different choices. Both investors own a home worth $600,000. They both owe $320 on their loans. They have the option to release up to $160 of equity by refinancing up to 80% LVR. Let's look at investor 1. Let's call her Jess. Jess sits down with the broker and a planner. She releases the $160 to a separate loan split, uses $120 as a deposit for a $550K investment, keeps the $40,000 as a buffer in an offset account that's attached to her investment loan. The new investment, it rents out for $540 a week, which is roughly 5.1% yield. It's negatively geared and maybe costs her about $50 to $100 per week after tax in the first few years. She's comfortable with that. She has a buffer. She stress tests her rates 2 to 3% higher. She knows her numbers. If that investment property grows at 5% per year over the next 10 years, which is quite achievable in the right suburb with the right drivers, that 550 becomes 896,000. She's built roughly 346,000 of additional equity minus whatever principal she's repaid. Now, let's look at investor number 2. We'll call him Dave. Dave also releases 160 grand, but Dave, he pays off 40 grand of credit card debt and personal loans, spends another 60 grand on a new car and toys. He puts 60 grand into finishing the house with overcapitalized upgrades that don't move the valuation that much. On paper, his instant stress reduces. He's got less credit card debts. He's got a new car. He's feeling pretty good. He feels rich, but his total debt has grown by 160K with no additional asset to show for it. All those other debts that he's no longer paying, they're still there, just rolled up into a 30-year mortgage, which he'll pay additional interest over time. So let's fast forward. After 10 years, Jess has a home, plus another investment worth 896, plus 10 years of rental income and experience as an investor. Dave, he's got his home, he's got a car that's now fully depreciating, a house that might be worth a little bit more, but he's close to the bank's limit with fewer options and a much bigger mortgage than he would have had otherwise. So same equity, same bank, 2 totally different outcomes. That's the power and the danger of doing equity release. So let's finish up with how to do this properly. If you're considering doing equity release, here's a 5-step checklist. 1, be crystal clear on your purpose. Ask, what exactly is the equity for? How does it advance my overall or holistic wealth strategy? If you can't explain the purpose in one clear sentence like, this will be a 20% deposit plus cost for investment X in suburb Y, you need to stop and reconsider. Step 2, protect your buffer. Decide up front how much equity you want to keep as a safety margin. For many investors, that means not going above 80% LVR unless there's a very strong reason. Stress testing what happens if values drop 10%. If releasing that equity would leave you exposed to even small downturns, you're probably going too far. Step 3, model the new repayments and total interest. Don't just look at it as a new monthly repayment and say, yep, I can afford that. What you want to see is the new repayment versus the current repayment. Total interest payable over the life of the loan versus the old loan. How many extra years of debt have you just added? You guys need to work with your broker or advisor to run these scenarios, keeping the remaining term versus resetting for 30 years, making higher volatility repayments or just a minimum. Now, step 4, use separate splits. When you release equity for an investment, you need asking to set up a separate loan. One split for your current home, which is non-deductible debt, and one or more splits each investment based on its use. That makes your life much easier at tax time, and it makes it clear if you want to pay down non-deductible debt first. Step 5, get independent advice. Don't rely solely on the lender or the broker selling you the new loan or product. For more complex scenarios, ASIC explicitly recommend getting both legal and financial advice so you understand the long-term impacts, especially around compounding interest and loss of equity over time. Even for straightforward cash-out refinancing, a good property-savvy planner or a broker can help you line up the correct structure, walk you through risk management, and a strategy for how the equity actually builds your portfolio. Now, this has opened your eyes a bit to the risks as well as opportunities for releasing equity. Tap the like button on the video so more investors get the full picture before they just ask the bank what they can borrow. And tell me in the comments, are you planning to release equity in the next 12 months? If so, what's the one thing you're most worried about? Is it the repayments, your capacity, picking the right property? Your answers really help shape what we go into next. Now, if you're watching this and thinking, I know about equity, I know it could accelerate my portfolio, but I'm generally scared of stuffing this up or ending up with a huge mortgage with no real exit strategy. You're not alone and you don't have to guess. This is exactly where a property strategy session can change everything. In a session with our team, we'll map out how much usable equity you have, how you can safely release it without wrecking your buffer. Model out different structures and repayment options so you see the real long-term costs, not just the shiny upfront cash. Now, we also connect an equity release to an actual property strategy where you're able to buy your next property. We discuss the price points and what the loan structure looks like. That way, you walk away with a clear answer to, should I release equity now? How much? And what's your next move once you do? If that's the clarity you've been missing, hit the link below. Book a free session with us today. And let's make sure releasing equity becomes an accelerator for you, not a handbrake.